Miami's rental market appears to be holding strong through the fourth quarter of 2022, but it is starting to show some signs of weakness. And in this video, I'm going to show you where the cracks are occurring. Hi, I'm David Monroe, CCIM. This is my 11th year in the multifamily industry. I've been a broker, I've been a syndicator, I've been a passive investor, and I've been a JV partner as well as owning a multifamily property management company. I teach market analysis for the CCIM Institute as one of only 60 instructors in an organization of over 13,000 strong. In this series, we are going to talk about the multifamily rental markets across the United States, and we will be doing a video every day, Monday through Friday, all the way through 2023, so that we can all keep abreast of what's going on in the multifamily rental market. I look forward to providing you all the data. Welcome to Miami. So as I said in the introduction, Miami seems to be holding fairly strong through fourth quarter 2022. So as usual, let me show you what our search filters are. So we are excluding all corporate, all military, all senior, and all vacation. And we are only looking at conventional apartments, so market rents. So we have market and market affordable selected in our data set. No other filters are here. In location, we have selected the Miami MSA, Metro Statistical Area. All right, and this is as defined by the United States and drawn by CoStar, which is the tool that I use for this data. So let's go look at some analytics, shall we? So as you can see, Miami has 188,611 units. There are still 28,713 under construction. They absorbed 3,638 in the last 12 months, which is way down from the previous 12 months of 13,194. Vacancy is ticking up. It was at 3.3 a year ago, and now it is 4.7. Rents still seem to be climbing, at least on a year-over-year basis. We'll see what it looks like on a quarterly basis, and price per unit continues to climb in that market, and cap rates continue to fall. All right, so let's look at the data. So this is all asset classes, A, B, and C, all beds, all history. So it goes all the way back 22 years. We're not going to go all the way back there. We're going to stay up here in the last few years, and we are looking at this on a quarterly basis. With CoStar, we can look at just the studios 1s, 2s, 3s, and 4+, but we don't do that in these videos. So we also look at effective rent, not asking rent. Asking rents are what the property management company wants to rent it for. Effective rent is what they actually rent it for. So we are going to look at effective rent. So when we look at effective rent in the first quarter of 2021, it was at $21.37. It increased in quarter two and then decreased in quarter three, stabilized from that decrease in quarter four. We are not looking at the Q1 data for 2023. There is not enough information. This is erroneous data. So we will not be looking at this probably until about February or March. CoStar lags about 6 weeks with their data. Okay. So let's scroll over and see why we are getting this decrease. Now, again, this is all asset classes A, B, and C. And you'll see, because I looked at this market before I did the video, that there is some differences between the A's, the B's, and the C's, and it may surprise you what they are. So when we look, 308 units delivered in Q1, and they absorbed 1,035. So that's really good. That explains the rent increases from Q1 to Q2. We love it when we absorb more than we deliver. But then you delivered 1838 in Q2, but you only absorbed 483. This explains the decline in rents from Q2 to Q3. You delivered another 3883, but only absorbed 1786. Okay, and then another 438 in the fourth quarter, with absorbing 305. So the market is definitely softening. So we're starting to see some weakness here. And as you can see, the vacancy is increasing, or here occupancy is decreasing. If you look over here, you'll see vacancy is increasing, occupancy is decreasing. But let's look at it on an asset class basis, and we will start by looking at Class A properties. So here is the Class A data. So we can see that effective rent, we had $28.71 in the first quarter, $29.75, so an increase in the second quarter, and then we declined in the third quarter and declined again in the fourth quarter. So it looks like the Class A's may be what is causing the decline in the overall market. We'll have to look at the B's and C's to see. But the Class A's definitely are struggling at this point in Miami. And if we look at deliveries, we delivered none in first quarter and absorbed 617. So that's good. Explains the increase in rents from Q1 to Q2. But then you delivered 1114 and only absorbed 762. Delivered 2109, only absorbed 701. Delivered 331, and you absorbed 438. But if we add all of these together, we got about 1140. It's 1139. I'm just rounding. So you got about 1140 that absorbed and 2400 that delivered. So we're way under, about 40% absorption to delivery, which is not a good sign for the Class A market in Miami. So we definitely see some cracks and some softening here. And you can see at the beginning of the year, occupancy was at 95.3. At the end of the year, it finished out at 91%. So pretty big decline for Miami in this rental data. Well, now let's look at it on the Class B side. So here is our Class B data, and you can see by looking at effective rent, Class Bs have stayed pretty strong in Miami. So we started the year at $22.09 a month. We increased in Q2, we increased in Q3, and we increased in Q4, albeit not much, but still was an increase. So the Class B market appears to be holding up, propping up the Miami market right now. So let's look at our deliveries and absorption and see how that's faring out. So we delivered 248 and we absorbed 232. So almost a 1-for-1. We like that. In Q2, we had 722, absorbed 473. So about 65%-ish, 2/3 absorbed to deliveries. It's a little softening, but not too terribly bad. Delivered 1774, absorbed 1398, so another, 70%, 65-70%, so another 2/3. So we can see why it's slowing down. That rent trend is slowing. And then we had the 107 units deliver with 202 absorb. So when you add all these up, our absorption is probably around 73%. I didn't run the numbers. I'm just looking at it, eyeballing here, of deliveries, which really isn't that bad. So the Bs are definitely propping the Miami market up. And even though they're showing signs of slowing, there isn't a sign of decline yet. But I think as we look at it future into the next quarter, we will probably start to see some declining rents because we're seeing that softening, and there's still 6,500 units to deliver. So we'll see how that fares out. Now let's go look at the Class C market. So here's our Class C data, back to effective rent. And honestly, I was surprised at what I saw here. I did not anticipate when I looked at this data before doing this video that the Class C's would still be this strong, although starting to show signs of weakness. So if we look at, we started the year at $1377 a month, increased $30 in Q2, increased $16 in Q3, increased $13 in Q4, but consistent increases all the way up through Q4. So we definitely are being fractured in the Miami market by the Class A's. The B's and the C's seem to be holding strong. But what's interesting about this and why I was surprised to see these increases is because if we look at our absorption, and you're not going to have construction in Class C space, I think CoStar in this case, there may be some properties that will be delivered as Bs that are under construction in really, really poor areas. So CoStar's identifying them as Cs. So I wouldn't be too concerned about the deliveries and the under construction for the Cs. What I do want to look at, though, is the absorption. If we look, the last 3 straight quarters, people have been leaving the Class C market. Now, we can say that they've gone from the Class C to the Class B. That is possible, albeit when you look at the rent increases, we're at $1,400 plus for the Class Cs. We were at almost $2,300 for the Class Bs, and then it was $2,800 for the Class As. So I'm not sure that they're going to pay an additional $1,000 a month just to have some better amenities. I think what may be happening here is with the Class C market that there's some affordability issues starting to happen. And seeing this negative absorption, which means that in second quarter, 253 more people left the market than entered the market. 313 more people left the Class C market than entered the market. It's just a result of end of period minus beginning of period. So from April 1 to June 30, at June 30, there was a number minus what it started at. In this case, it became negative, means more people left than actually entered the market. And that happened 3 straight quarters. Yet we're still seeing increases in the rents, even though we're seeing the occupancy tick down, albeit very, very small. And I think it's because if we look, there's going to be, look at our inventory, 100,000, almost 100,000 units in the Class C space. So when we look at that, these small numbers aren't putting that big of a dent in it. So we're still seeing these increases in the rents, even though people are starting to leave. And again, I think it's due to affordability. I don't believe these folks are jumping to the Bs because of the large price difference. It's just my opinion. So this concludes this video. That is the Miami market. We looked at the overall market, the A's, the B's, and the C's. And the A's are definitely showing the largest sign of fracture. And the B's are plateauing. And the C's, I think, will start to see negative trends with the C's, especially if this negative absorption continues. There's no way those rents can continue to go up with this. So thank you for watching this video. And tomorrow we will be doing the Tyler Longview Metro Statistical Area. It is a smaller MSA in between Dallas and Shreveport along I-20 in Northeast Texas. I look forward to seeing you tomorrow.